Ladies and gentlemen, the bond rally that I've been waiting for a long time could finally be here. And these are the reasons why I think the bond rally is going to be here. Let's watch on, shall we? So in today's video, I'll be talking a lot about the backdrop of why I think a bonds rally could finally be here. And I will analyze the whole market situation, looking at reasons why the bonds market originally tanked and now could finally be the moment we are waiting for. But let's watch on, shall we? As usual, these are my disclaimers that this content is for education and entertainment, not financial advice. Remember, hit subscribe as I share with you more important and exciting information. The whole reason why I think this thesis of a bonds rally could finally be here is largely because there is a trigger, and the trigger is the weak August job report. And right now, we have already seen, I told you that the labor market yesterday came out with a very bad job report of only 22,000 jobs added in August against a forecast of 75,000. And anything below 100 plus thousands is actually a very bad number. And we are in a very bad number. Unemployment rate in US is creeping up, and it shows a overall slowdown in a significant way in the jobs market. And these are the two pillars of why the Federal Reserve exists, which is maximum employment and maximum price stability. And right now we are not achieving the job stability. As the results come out, there was initially a euphoria with the S&P 500 breaking all-time high again. And over the next 1 to 2 hours, it started declining. It went into losses. And then the market couldn't decide whether that's good news or bad news. And it went up again and it went down again. And it eventually ended at a slight negative versus the previous day. On the other hand, the Nasdaq was more decisive. Yes, it experienced the same decline, but it at least gone up to at least a slight positive. The one thing that everyone was very clear is that whenever there's a likelihood of an interest rate cut, you get a bonds rally. And already yesterday, we see the TLT going up by 1.5%. So all these are very interesting signs. Today, we will focus a lot more on the bond situation, and let's watch on. Because of the current situation that we are facing in the labor market, most likely we're going to have an interest rate cut and maybe even more. What do I mean by that? The CME Fed Watch 2 is really pricing in 100% or near 100% chance of a Federal Reserve cutting interest rate in September. But what is interesting is that there is now a higher chance that there could there could be an interest rate cut of not just 1/4%, but even 0.5%, which will be very significant. And there could also be a chance that there will be not just one rate cut, but two rate cut towards the end of this year. So I think all these are very interesting trend that's happening. Of course, it's spell of things that are probably worsening in US, and it is definitely a good sign for bonds. Well, Donald Trump reacted to the bad news by saying that, it was Jerome Powell's fault. Jerome Powell is too slow and has choked the economy. So he actually criticized Jerome Powell in a very extensive way and said that, he's the cause of all this economic problem. And to make matters worse on the market uncertainty, he has previously fired the Bureau of Labor Statistics chief and basically called the jobs data fake. So right now, we are not too sure whether how Jerome Powell will react to Donald Trump's accusation again. But I must say that in my opinion, Donald Trump is not exactly wrong in calling Jerome Powell too slow, because Jerome Powell is always looking for data that is backward looking. And by the time the data is here and he reacted, it will be too slow. He did that when the market was reacting and having inflationary pressure. He was too slow in increasing interest rate. Right now, he's too slow in cutting interest rate. So there are some structural weakness in US, and we have to acknowledge that. So the tariff impact is something we have not seen, and I think it's beginning to show. And certainly, hiring is weak. And I've talked about it at length. There's not just an economic impact, there's also artificial intelligence impact as well. And finally, we do smell some signs of a recession risk. All these are suggesting that the Federal Reserve could be forced to take a aggressive action. We know some of these things are coming, but why is the Federal Reserve dragging its feet is because there's always a risk of an inflation because of the tariffs, the inflation risk is not gone. Had it not because of Donald Trump's tariff, the interest rate cut would have happened long time ago in a big way. Now, unfortunately, the inflation risk is not gone because of the tariffs impact. There is a risk right now that the Trump era and the new tariffs are driving higher import prices across consumer industrial goods. So I think this is quite serious, and there could be some sticky components of certain goods and services, and that's potentially driving prices at a sticky level high. And there's now an additional uncertainty of the tariffs legality, with the US Court of Appeal ruling that some of the existing tariffs are implemented illegally. And now we await for the Supreme Court to take an action on seeing whether they will cite the courts of appeal or Donald Trump's administration. Now, all this could add to more uncertainty, and uncertainty is always bad for investments and for businesses, and there will be economic consequences. So let's now analyze the bonds market and see where the potentials are. There is a first principle that I want to impress upon everybody is that there is an inverse relationship between interest rate and bond prices. When interest rate comes down, bond prices goes up, and when interest rate goes up, the bond prices comes down. That is not a maybe, that is a rule. Now, the US Treasury Bonds is a benchmark for the financial market for the bonds. And clearly, right, there are many markets that of bonds that now peg against the US Treasury as well. So if the interest rate were to decrease, most likely this will lead to an increase in bonds prices. To first understand the impact of the likelihood interest rate cuts, let's take a look at when interest rate rise, what happened to bond prices. The bonds prices crash, and in fact, crash in a massive way in 2022 to 2023 when Jerome Powell spiked the interest rate phenomenally high. So at that point in time, the CPI, the inflation rate, hit a high of 9.1%. And as a result, the Federal Reserve quickly spiked the interest rate and spiked interest rate really high. And unfortunately, that led to a bond price collapse. And the long-term treasury losses were in the tune of 40%. So a 30-year treasury lost about 30 to 40% from its high. And that's very painful for many of the bonds investor. And I have quite a substantial sum of bond investment at that period of time as well. If bond prices were to fall when interest rate goes up, the reverse must happen, right? So right now, what we have is there's a weak economy, jobs market is deteriorating, and as a result, we should expect the interest rate to cut by the Federal Reserve, and this could set the bonds prices to rally. And the short-term bonds would rally less, and the long-term bonds should rally more because of the nature of how this thing works. Now, is this a time where everyone should quickly rush to buy bonds right now? Well, unfortunately, that's what I thought, early this year and late last year, where that's before Donald Trump came in office. I thought that, the likely scenario is that bond prices is set to go up because the inflation rate is coming down. But lo and behold, no, because Donald Trump slapped tons of tariff across the world, and as a result, that is deemed inflationary to the Federal Reserve, and as a result, they held back the interest rate cuts, and that disappointed the market and caused the bond prices to go down further. And to add to the confusion, Donald Trump actually did a lot of things that undermined the Federal Reserve credibility, and almost at one point in time threatened to fire Jerome Powell, and that caused the market to lose faith in US treasuries, and also the US debt were rising and the bubble was blowing, causing more and more investors to lose faith in the US treasury. As a result, the bond prices start to come down in a very big way as well. Now, things could change. Number one, we are now looking at the possibility of letting Jerome Powell now, come to his retirement of his term, and if the tariffs were to if the tariffs were to continue, we'll most likely see a lot of revenue coming into the US budget. And as a result, the government will have lots more money, and the debt required will be a lot less and more stable, and so on. So all these are risk scenarios. So if the inflation continue to be sticky because of the tariffs, then we could potentially have the bond prices being stuck or even go down further. And if the Federal Reserve, for some unforeseen reason that I cannot understand, that refuse to cut interest rate, or at least give a hawkish cut, that means they cut but say, I think it's still very dangerous, we're prepared to increase interest rate anytime. That could disappoint the market as well, and then the bond prices will not go up. Or Donald Trump and Jerome Powell could have some fights, and maybe the court of US could suddenly rule that these tariffs are unconstitutional, illegal, and suddenly remove all these tariffs. Then all these revenues won't come in and causing the debt bubble to go up even further. Everything could cause the entire bonds rise to not happen. So there are risks to my thesis as well. So what should I do? Well, I already have taken a substantial position in bonds of various forms. I'm going to intend to keep it there. Whether I'll take on more position, I don't think so. But I'm really taking a pretty substantial position in bonds already. And the best part is I already informed everybody that I've taken them months ago, as this was my belief that one day the bond prices will have to go up as the interest rate come down. And the other one is I diversify, right? I'm not all into bonds, I'm not all into equities, but I spread them all out, some into CPF, some into other assets as well. So I actually think that diversification will be fine. Most of us are underweighted on bonds, including myself. Despite me taking a substantial position in bonds, I'm still underweighted on bonds. So logically, I could have a thesis to take up more position for myself in bonds. Okay, that I have to think through. Just to give you a feel of some of the bonds trend we're looking at. Actually, late last year, the bond prices of TLT, the ETF of long-term treasuries, actually went up quite substantially to about 100 over points. And after that, because of Donald Trump's tariffs, it went down and down and down and down to 80 over points. And recently, it started to go up again. Now, could this be a sign that you go up above 100? I don't know for sure. I believe that it could go up with some risk and some caveat. But certainly, the other position I've taken, I announced to everybody my position, is my PIMCO fund, right? My PIMCO fund was put in earlier this year. Okay, I can't remember the exact months. And when I fired, I told everybody. In fact, I showed everybody as I fired because I was with Sam Ree from Endowers. I took a pretty substantial position, and fortunately, the market has already reacted and gone up. Now, it could go up even more. We're not too sure, but certainly those bets were turning very interesting and positive. What could the direction be? Would you believe that you will go up or you'll go down? Is something that you have to decide. Okay. I think that you'll go up with some risk. So I think I'm willing to accept those risks. But I think diversification is obviously the best position for everybody, including myself. Thank you for watching. I hope to see you in the live stream tonight. Bye bye.